Thank you. Thank you very much for having me, presenting some of my recent work. I wish I could be there in person, but digitization does help. In any case, I'm just glad to connect. As I was saying earlier, I'll still touch on this paper on inclusion and democratization in Web3 and DeFi using evidence from the Ethereum ecosystem. But given what's going on for the past few days, with the allegation by the SEC against Binance, as well as earlier charge on Coinbase, I figured I should just share a little bit on the dark side of the sector and how economic research could be helpful in terms of providing insights and so forth. Okay, so what do I plan to do? I'll quickly touch on a few topics before I go to that paper. And if you want more details, you can look up some of the papers I mentioned here. There will be more details, but one particular charge or allegation on Binance is was trading. Binance US, I think the allegation mentioned over 30% was trading, something like that. So I'll definitely start with that. And we should also notice that the charges against Binance and Coinbase are quite different. The CEO of Coinbase wasn't really involved, and there wasn't a fraud charge on Coinbase, but there is one against Binance. And I think as of yesterday, the US operations, Binance US has suspended its operations. So starting with Wall trading, what's Wall trading? Wall trading is essentially kind of selling and buying by yourself, right, to fake transaction volume. It's one of the three major manipulations in the crypto space. The other two being pump and dump and spoofing. There are probably more variants of these manipulations. So this paper was actually first written in 2019, and that speaks to the limited audience that academic articles or working papers have. Until recently, people start to kind of pay more attention to this. But we're trying to provide a systematic characterization of the Wall trading phenomenon. Before that, it was only kind of anecdotes or kind of speculations by industry kind of blogs or reports that's not quite as rigorous. So what we did was we collected centralized exchange data, transaction level data from 29 CeFi exchanges, right? Back then, CeFi was still dominant. Well, even right now, CeFi is dominant. 3 of them were regulated, actually, including Coinbase, with the big license from New York. 26 were not regulated, and that's by US standard. You can use alternative regulatory framework by using the British one or Japanese one. You find similar results. So we see all the transactions, we don't see the ID. We see all the transactions and orders posted or reported by the exchanges, but not the ID of the wallets and all that.
Will, can I ask a question?
Yes, please, anytime. Yeah.
Can you give a little bit background in traditional finance in Wall Street? So
yes.
What trading is illegal and there is regulation to monitor that is not?
Absolutely. So Wall Street is banned in most other major asset markets. For example, in equity market, if a exchange misreport or try to fake transaction, that's not allowed. That's illegal. For individuals, can I quickly buy and sell the same security? Yes, we could do that. But then you can no longer report any loss from the selling of the security for tax purposes. So basically, Wall trading or Wall trades cannot be used for tax reporting, and you can't outright fake transactions, right, in other markets around the globe, pretty much. In the crypto space, it's still murky, right? People are trying to develop more regulation, but back in 2019, 2020, or even 2018, it was, I think, very prevalent, as I'll show you from the data. It's still ongoing in some alternative way. That's why tighter regulation, and you were pointing out the regulation aspect, the regulated ones were behaving better. So in that sense, having regulation, having the threat of being audited at some point, and these are CeFi exchanges, so you can actually track down who's responsible, is helpful. So in that sense, it's not too different from traditional financial markets or institutions, right? It's just a financial intermediary is doing something that they should not do. Why do they want to do it? Faking transaction gives an impression that we have a lot of liquidity and activities, more people come to my exchange, I got ranked higher, I receive more revenue from the fees I charge. Okay. Again, without going into the details, you can use statistical tools to detect what's trading. We use a couple of that. One of them is Banford's law, basically the distribution of first significant digits in the transaction sizes. Banford's law works broadly. If you look at the length of river, heights of mountain, sizes of firms, transaction sizes in equity market, they all fit pretty well. But if you look at crypto, the red dots are what Banford's law would say about the distribution of the first significant digits. The middle blue bar is actually R2, R stands for regulated. It's actually Coinbase. It was complying with that. The UT and U, these are unregulated exchanges. We kind of put them in two bins. One is kind of higher ranked, more prominent unregulated exchanges. The idea is maybe they care about reputation, right? So they are already well established. They don't want to risk being caught. Whereas U stands for lower ranked ones. Actually, how we do that categorization doesn't matter. What we report is at exchange level. So we do that for each exchange. But you can already see the distribution deviates from the Banford's law for major pairs of exchanges, right? From crypto to Tether or Circle, right? To USD dollars on these exchanges. You can also look at rounding.
Sorry, there's a question in Q&A regarding token selection.
Yes.
Regarding token selection, why do you choose XPR and LTC rather than other mainstream tokens?
Well, these are the four most major tokens, right? Bitcoin, Ether, Lightning, and Ripple. At least when we were conducting the exercise, we have data on other pairs as well. And in terms of volume, they pretty much cover the majority of the transaction activities, kind of value weighted. But we look at some other pairs, and in general, I wouldn't be surprised. In other pairs, there is still wash trading. So in a way, the wash trading is even more severe than what we report here. Here we're just reporting, a large chunk of the activities in the sector covered by these four tokens, but there's definitely more. Rounding, that's another behavioral pattern, right? Around multiples of 5s and 10s, we tend to round up. I don't submit an order of 1.1123, 5, 6, 7, 1, 1. I submit an order of $50, 5 shares, 100 shares. So if it's authentic trade, you can see around the round numbers, the frequency of transaction should go up. And that's what we observe on regulated exchanges. Large transactions are rarer than small transactions. That all makes sense. You go to unregulated exchange, no rounding seems to be happening. The distribution of transaction sizes is kind of odd. So these are not a proof that this is wash trading, but these are red flags that the trading doesn't seem to be authentic or real, right? You could argue if I fake transactions to fit these patterns, then you wouldn't be able to detect that. Absolutely. So the usual Lucas critique applies. But back then, I don't think people were having in mind, like if I'm doing Wall Street, I need to try to fit Benford's law. I need to try to fit rounding pattern. I need to try to fit the tail distribution rate following some power law. And there are many other statistical patterns. Nowadays, maybe people try to fake that, but it's an ongoing game of fight. We need to develop new tools to detect such manipulation. But if you go quantify the Wall trading, regulated ones don't seem to Wall trade. Unregulated ones, on average, Wall trade over 70% of their transactions. So they are faking a large fraction of their transaction. Now, this is back in Q4 2019. Things could have changed. Maybe they became better. I think based on our estimate, Binance.com was close to 50% Wall trading. Not too far off with what the SEC is trying to report or claim. But that Wall trading is happening at exchange level, right? There could be Wall trading happening at the individual level, especially for tax purposes. So the idea is, you can tighten tax scrutiny on crypto activities. Basically, Coinbase users were issued a letter back in 2018 saying, we're watching you. So if you are trading, you better report this in your tax. What's going to happen when regulation tightens? Well, people are going to comply more, right? They're going to report. But one loophole, and that points to the importance of coordinating policy, is, well, you can tighten tax rule, but if you don't ban Wall Street, what people can do is, towards the end of the year, I can quickly sell my losing positions in, let's say, Bitcoin, and then buy it back right away, and then report that as a loss to offset my tax that I have to pay from gains in other trading or investment activities, for example. So it's a form of tax loss harvesting. And in this paper that's forthcoming in Journal for Accounting and Economics, what we document is essentially, there is Wall trading associated with tax loss harvesting, and the IRS is leaving a significant percentage of tax revenue on the table if they don't coordinate regulation that covers Wall trading as well. And there's a question in the Q&A box. Could you let us know if the trade size you showed is related to just submission patterns of trades or confirmed trades? Did you consider submit and cancel the trade patterns too? These are the reported realized transactions. So we don't have the full, order book or orders that's canceled. But these, some of the transactions that's reported are not real. So that's the part that we're trying to detect. So we can't use the data to study, let's say, spoofing or sniping type of manipulation. Great. So that's on Wall trading, right? That's one major issue that's being discussed. But what's more importantly is, even back in 2019, actually, even earlier, when in 2017, when we were working on this mining pool paper with Zhe Guohe and Justin Lee, we're trying to point out, yes, people worry about concentration, right, in the crypto space or in the blockchain space. But the worry on horizontal concentration really shouldn't be the major concern. What is the main problem is vertical integration. CeFi entities are very vertically integrated without proper disclosure and regulation. So that leaves them a lot of incentive and room for manipulation. That's what happened with Wall trading. That's what's happened with FTX. So you can actually, offer some useful insights. Whether you get that read by a wide audience is a different issue, but this is a space where economists can come in and really provide some useful analysis. And just to give you a concrete idea, right? I'm not going to talk about the failure of FTX. There are many articles kind of on it, but at one point, people were really worried about concentration due to the rise of mining pools. What I'm showing you here is horizontal axis is time until the end of 18. The different color blocks are just sizes of different mining pools. You can see as a percentage of overall mining or electricity devoted to Bitcoin mining. The red line is the aggregate electricity in terms of level over time. So you can definitely see mining pools become very dominant at one point, close to 98, 99% of all the mining activities for Bitcoin. And people are worried, right? Some mining pool will become a winner that takes all. But looking at the figure, we don't see a mining pool becoming too dominant. And so why is that? Well, what are mining pools? These are risk-sharing contracts, risk-sharing portals, right? As an individual miner, it's risky. I don't get a smooth income, but I join a big mining pool. It's like joining a big firm. I get a more stable income, and the firm has a higher chance of winning the mining rewards, the coin base. But why wouldn't we see winner takes all in this space? Actually, some simple economics would explain this, right? As an individual, when I allocate my electricity or computation power to various mining pools, I will allocate more to the bigger pool, right? It gives me more benefit, risk sharing benefit. But at the same time, this is a portfolio problem. I don't put all eggs in the same basket. I'll still allocate some to the smaller pools just to diversify the risk of not coming up with the right solution fastest. So what that means is I'm not going to allocate disproportionately more to larger pools. On top of that, there is a IO force, which is something we should be familiar with. Large firms have bigger market power, and when they have bigger market power, they can charge a higher fee. So larger mining pools charge higher fee. That's something we verify in the data. And because of that, people actually allocate in terms of percentage less to the larger pools in terms of percentage growth. So what that means is there's some sort of mean reversion. Larger pools are not going to take over. At least that's when you only consider horizontal computation. Now, if you think about some mining pools also own a chip production and also owning a crypto exchange, that's a different story. They are vertically integrated, they can do a lot more, right? And back then, another issue, another claim people typically have is, well, there's increasing energy being devoted to Bitcoin mining or proof of work-based mining. That's because the cryptocurrency price has been growing. Cryptocurrency price contributes to that. But actually what we found is it's not first order. That's not the main story. The rise in the energy consumption, all that, is really due to the rise of mining pools. And again, so do I have that here? Yeah. So this is a figure where horizontal axis is the cryptocurrency price, vertical axis is the aggregate electricity devoted to mining. Solid line is if you mine solo, what's the aggregate electricity devoted to mining. You can see, price increasing can increase that, but it's not monotone and it's not a huge increase. But the dotted line, the second dotted line, is actually the mining pool equivalent. In the presence of mining pools or with full risk sharing, when the token price increases, the electricity used could easily triple or quadruple. So the presence of mining pool is really exacerbating this problem. And the intuition is, if you ensure bank robbers You share prison sentence if one gets caught. What are people going to do? They'll rob more banks. And here, people are going to devote even more electricity to mining if there's risk sharing, and that overall increases electricity consumption, which in turn will have environmental ramifications. So these are examples where some simple economic analysis can tell us quite a lot about the issues that's happening. Right, there was a big debate on POW versus POS, the environmental damage, so on and so forth. Anyhow, that's about the issue of vertical integration and how we can look into that space. I'll briefly touch on the more explicit crimes. Right, earlier on it's kind of gray area, murky water, but it's some are not currently labeled as illegal. No, there are crimes that are clearly illegal, and the two biggest cyber crimes associated with cryptocurrency or blockchain or DeFi would be ransomware attack and scams. So what is ransomware attack? It's a malicious software where they can lock up your file and data and demand a ransom in order to unlock that. It can happen through various channels, right? A USB drive or a website that you typically, third-party website that you typically visit. They can plant something there that's called watering hole. They can use email and so on and so forth. And there are several ways they can extort value, the criminals. They can say, you have to give me ransom, otherwise I wouldn't unlock your data. Or I can say, well, I'm going to share your data with your rival or with your users. If you're a public firm, leaking user data to the public is going to be very bad for your firm, right? So these are ways that they can threaten and negotiate with you, and they typically tell you, you just have to trust us. Once you give me the ransom, I'm going to return the data to you and not release that to others. And indeed, they run the operation like a business. The dominant players are ransomware gangs that essentially they do research, they do due diligence on how much their victim can potentially pay. They have an affiliation program. They offer ransomware as a service, right? It's a RaaS model. They develop local affiliates and share the ransom that they collect. And if you look at ransom payment in Bitcoin, this is the trend. You see over the past few years, it was going up. And one major driver, actually, I'm going to ask you, what do you think is one major driver for this? Why was it increasing so much? I don't know if I can see hands raised, but if you have to guess, right, why was it increasing so much from 2019 to 2021? What happened during this?
I will say COVID.
COVID, right? There's a big major macro shock around the world. Why COVID is relevant? Well, we get sent back home to work from home, and the network security at home is not quite there compared to corporate network security firewalls. So that could be one driver. But why did it decline over time? Well, maybe recent data haven't been collected, and that actually points to the under-reporting problem. There isn't a central place to report ransomware attack. And people also don't have incentive to report that. If I'm a public firm, why would I, unless I'm required, why would I want to report that I got a cyber attack, right? And another reason is, well, some cases were caught and sanctioned. Some criminal gangs were sanctioned. So they switched to even more anonymous payment systems, such as Monero, rather than Bitcoin. That's why there could be a decline in the amount paid in Bitcoin. And this is an example, right? Evil Corp was sanctioned back in 2019. And if you look at their revenue after the sanction, it actually shoots up. What did they do? They rebrand, they reorganize. It's the same trick. They use a variant of the ransomware, and they relabel themselves and all that, right? So it's actually very hard to fully eradicate these criminals. That's ransomware. The biggest crypto-related crime would be crypto scams, and scams are not alien to us, right? We've seen that throughout human history. I guess what is relatively new is rug pull, right? In DeFi protocols, you leave a backdoor, things seem to function normally until all the value, a large value is locked into the system, and then you just take the value and disappear. That would be a rug pull. And the largest case there, I think, is even higher than $2 billion for sure, plus token. And that involved over, I think, 3 million victims. Basically, people were using Telegram, WeChat. It's just a Ponzi scheme, right? There's a very attractive ICO of our token, plus tokens, you invest with us. And they try to organize conferences, appear together with royal family, things like that. So, there's a lot going on, and you can, if you are coming from a statistics background, data science background, you can do a lot of kind of detection, forensic work. If you're coming from more economic background, think more about economic incentives and market design, or mechanism design in the space would be interesting. And if you care about the socio-economic implications, then you can look at this system to think about inclusion and democratization, which are the original claims for Web3 systems, right? Or DeFi or blockchain. They are inclusive, they are democratic. Is that true? That's what we want to study in this paper that I actually hope to focus on today. But before I do that, any questions from the audience that I can quickly take? All right, if there isn't a question, I'm going to continue to discuss this paper. So, are the fundamental claims Web3 or DeFi systems are inclusive and democratic true? What is the largest platform, Web3 platform of DeFi? Well, I would claim Ethereum is the largest. Bitcoin is, bigger in terms of token value and all that, but it doesn't have smart contracting. It's not really DeFi. Things could change, right? People are developing additional protocols that might allow some programmability there, but so far Ethereum is dominant. And what we do in this paper is really 3 parts. The first part is descriptive. We just want to put together a data set, share with other researchers, and also describe some simple patterns in the space, including the distribution of income, distribution of wealth on chain, and distribution of activities. Then we'll come to how the suboptimal transaction fee design really makes the system exclusive. It's not inclusive, even relative to traditional economy at the moment. But not all hope is lost. There are recent changes, such as EIP 1559, and also programs such as airdropping, that if you really think about them, you will realize they are redistributive monetary policy that actually affects the distribution of income and activities. Why do I call them monetary policy? Well, if you think about airdropping, what are you doing? You are minting new tokens, you're printing money, and you're giving it to whoever receives the airdrop. So it's a transfer of wealth, it's a redistribution. I'll come to the EIP 1559 fee in a little bit. It's very similar to taxation. Okay, so in the interest of time, I'm not going to talk about the literature too much, but safe to say this is related to transaction fee, studies on transaction fee, DeFi, Web3, and more generally, how transaction costs affects financial inclusion. This is definitely the largest data set and computing that I've worked with, you know, it's actually more than 3 billion if you count internal transaction logs within Ethereum. We have to use 14 large computer clusters in Xi'an Jiao Tong University. And beyond basic Ethereum and ERC20 token information, we use some complementary data sources, right, to help with the analysis. Right? Addresses associated with certain DeFi, DApps, Ether, gas station, coin market cap on the market data, so on and so forth. And it's pretty comprehensive coverage. I forgot to update. I think we actually started now in 2015, so it's a good coverage of all the information. We put some kind of slightly aggregated processed data in a repository that's public. The link is in the paper, so if you are interested, feel free to utilize that. It did take us quite a while to put this together. You know, even to run a simple regression, it takes 20-30 days on this large data. There are also ways to visualize, the network structure and so on and so forth. That could be interesting. But in terms of what we kind of observe, I don't know how familiar you are with the Ethereum system, but basically there are accounts that are owned by individuals, right? I have tokens in it, I can do transfers, so on and so forth. I can initiate a smart contract. There's also contract, right? For a DeFi protocol that's running, it's not owned by an individual. It's just an account that records the steps of execution and the contingent situations spelled out in the smart contract. We look at both type of accounts, and for the service of record keeping activities in the ecosystem, the miners, at least before Ethereum moved to proof of stake, have to be compensated, right? And they are compensated using newly minted tokens, but at the same time, they're compensated based on the fees that people pay. And it's typically referred to as gas fees. And you have to reserve a certain fee. If your actual fee exceeds that amount, your transaction doesn't go through. But if it's below that, the transaction can go through. That's kind of the setup. And just very quickly, in terms of the income distribution, what we observe is there's high concentration in terms of income distribution. The top 5%, if we include mining pools, are pretty much the top 5-6 mining pools. They make up more than, I think it was 60 or 70% of all the income. And even if you exclude mining pools or you trace the distribution of mining pool to their individual nodes within the mining pool, if you only look at individual nodes, the top, I need to recall the number, the top 5% still covers 70% of all the income, something like that. It's highly concentrated. It's comparable to Bitcoin, and it's worse than the income inequality we observe, for example, in the US economy, which says the top 10% only earns the top, I'm trying to recall the number. The top 30% only earns the top 60% of the income, something like that.
Can I ask a question?
Yes, please. Yeah.
Go back to the previous, one of your papers. I think we don't need to go with the slide. It's just more about the logic, but it still can be the case that it's a big pool, but share with a lot of users. Yeah. So it could be that the inequality is even better than what we observe in the data, because in the data, if there is a big pool, you don't have any sense of how many users are contribute to this big pool, right? Yeah, that great point. That's what I meant by the tracing process. We do observe from the pool's wallet tokens being distributed out. Okay.
nodes. You can do one layer tracing, you know, maybe multiple layers of tracing. I think we did 1 and 2 layers. That's not 100% proof, right? Like you know, even after distributing it twice, maybe it's just distribution to another mining pool or a exchange. So it doesn't reflect individual income distribution. And even the individual wallets, one person could own multiple wallets. But multiple wallet ownership will only bias against, it will only enhance our finding, right? So not accounting for that will bias against our findings. So the concentration in general could be even worse. Yeah, but that's an important item that we should clarify. In terms of on-chain token distribution, here I'm just showing you ETH distribution. If you look at the Herfindahl index, initially it was concentration was decreasing because more and more people adopt this system and they create accounts. But over the past few years, it has gone up. Concentration has gone up. Again, we find the top, I think 0.5%, even 0.1% was owning a significant fraction of all the ETH value. This is not a full picture. You don't see off-chain holdings. You don't see the entire portfolio. But it gives you an idea of, you know, if we view Ethereum as a cyber country, the wealth inequality is pretty severe, even more severe than the wealth inequality in the US economy. So on all these fronts, it doesn't seem to be helping. What about transaction activities? Well, there are some general trends. For example, there's a, in terms of percentage of activities, there is a shift from, you know, being ETH dominated to ERC20 token dominated, peer-to-peer interactions to user interaction with the app and DeFi protocols. But what we observe at the same time is the transactions are dominated by large transactions. And this shouldn't be a given, because we were looking at Wall trading sizes, right? Large transactions should have lower frequency and all that, but why large transactions are dominant in this space? And that leads to our, you know, examination of the fee mechanism. So it actually has something to do with the fee design. Basically, whether I'm transferring $5 or I'm transferring $50, the fee that I have to pay is about the same, or the gas used in executing that transfer is about the same. So what that means is, if I'm buying coffee, I'm paying, you know, maybe 100, 200%, or even more, the transaction value. Whereas if I'm doing an international transfer to my Swiss bank account, this is, in terms of percentage fee, is cheaper than, let's say, using Swift or some sort of wiring system. That's very intuitive. There's a big fixed fee in transaction, and that naturally favors larger transactions of bigger players who can afford to carry out larger transactions, and that's what we observe in the system. There's a number of issues associated with that. Basically, there's a negative relationship between gas price and delay time. If you pay more, your transaction is less delayed. And when the system is more congested, you know, gas fee would go up. And these fees are not cheap, in the sense that you have to reserve the gas fee, right? And that means you're foregoing alternative uses of these tokens. And token price also fluctuate. There's high uncertainty, right? I might reserve some fee, but during the interim, maybe the price really drops a lot, things like that. So we document some issues related to that. Let me just mention, we also document high transaction failure rate. You know, sometimes as high as 9%. That's not the case with Visa or MasterCard. I mean, they decline some transactions because that's to protect you. But in general, transactions, proper transactions don't fail at such a high percentage. And if a system is not even functioning, it's hard to claim it's inclusive and democratic. Transactions could fail for many reasons, but out of gas is 30% of the failure. That's people just were not reserving enough gas. I think about it, it's going to be hurting the less sophisticated players, new players, right? Retail participants more, because it's harder for them to figure out the right amount of gas to reserve. You don't want to reserve too little because the transaction fail. You don't want to reserve too much because there's opportunity cost to that. And there are other reasons for failures. Reverted is just a condition you coded into the smart contract. By the way, the total percentage adds up to more than 100% because they are not mutually exclusive. They are not overlapping much, but there's some overlap. Let's see if I have more to say there. The volatility of Ether and ERC20 tokens are related. And because if you use ERC20 tokens, right, for your activities, you still pay the fees, the gas fee in ETH. So they are related. And in fact, the volatility in ETH is negatively associated with the other ERC20 tokens. Not surprisingly, right? If I have to pay a fee, which is highly volatile, that's going to hurt my ecosystem or hurt my business. And to the extent that tokens capture the project value, that also goes down. The ETH return is positively related to other token returns. That is less obvious because on the one hand, having to pay the fees in a different token rate in ETH rather than my own ERC20 tokens could lead some business away from the usage of the token. At the same time, if that makes the system grow faster, there's a positive effect, and that we do see a positive association. Okay? So that's about fees, and the fees obviously are not optimally designed, but changes can be introduced. The EIP 1559 was one set of changes to the fee mechanism that's aimed at easing congestion and all that. It wasn't designed to solve the inequality problem or inclusion problem. Having said that, it has such an impact that it reduces income inequality. It reduces the inequality in transaction activities, primarily due to one item in the new protocol. That is, there are some base fees that are going to be burnt, meaning sending to invalid addresses forever, so that it's out of circulation. So that's a deflationary measure, right? You're reducing the tokens that's in the supply in the ecosystem. And who's paying these fees? Well, we were saying large transactions, right? So people who have large transactions are paying these base fees that's burnt, which benefits all token holders because it's deflationary. It's very similar to a sales tax, consumption tax. Okay? And to the extent that large transaction players are also the ones with large balance in their accounts. That means wealthy people are paying higher fees. Right? These are very similar to tax. It's a transfer, and you can use the EIP 1559 introduction as a shock to the system and do a diff in diff to show that overall they reduce miner income. Not surprisingly, because some of the income got burned, but it has a effect on the miners belonging to larger mining pools with a smaller magnitude, because any reduction in mining income, the risk of fluctuations are mitigated due to risk sharing in mining pools. But larger miners, right, the nodes with higher computation power, they lost more. So in terms of leveling the income or reducing the income gap, the change basically has a positive effect on inclusion or democratization in that sense. That's on the miner side. If you look at the user side, you find an overall positive effect on transaction volume and number of dApps used. Basically, overall activities increase, and the increase is even more for users with lower transaction frequency or amount, which means those ones that were not very active, namely the small transaction players, they benefit more from the change. And that's inclusive. Going in that direction is not the optimal design. Similarly, if you look at airdrop, right, that's another form of redistribution, as we were saying earlier. And for that, we look at Omisco's airdrop. That was the first major airdrop, large-scale airdrop on Ethereum. And the idea is, if you have a balance, ETH balance above 0.1 ETH at that point, at that block height, which is around, actually slightly before the airdrop, then you will get allocated Omisco tokens proportionally. So what that means is you can do a regression discontinuity exercise, right, around that threshold, slightly above, slightly below, right? Slightly above you get airdropped, slightly below you don't. What is the impact? And what we find is that basically this is a redistribution, reshuffling of wealth somewhat. And in terms of transaction activities, it has a equaling effect for transactions, which makes it more inclusive. We also did an exercise where we look at the ETH price using a synthetic control method. And then we create a synthetic ETH price. Before the airdrop, they overlap pretty well. But after the airdrop, what we observe is that the airdrop has an effect on increasing ETH value. And that's, again, not clear ex-ante. Why? It's similar to, if you view the ETH as US dollar, right, in that cyber country, the airdrop of OMG is like suddenly introducing, I don't know, RMB in New York City. There is a competition and crowding out effect. But if that makes the business more prosperous, makes the ecosystem more prosperous, there could be an overall improvement in the valuation of the system that's reflected in the currency, right? So it could go either way. And what we observe is that overall it had a positive effect on the ETH value as well. And these are with causal identification. So it's not only descriptive. But that's pretty much the exercise that we did in this paper. And our main point is, even though Web3 and DeFi were advocated as innovations for inclusion and democratization, once you do this very first comprehensive analysis on this largest DeFi platform, we actually don't see those claims to hold. And just providing this basic description is informative for future research. And we do point out that the fee mechanism design is pretty crucial. That's causing many of these issues. But some recent changes are essentially redistributing monetary policy that improve overall financial inclusion and democratization. So, the system is constantly evolving. Things could change, but at least at the moment, it's not that inclusive. Okay.